Well, good morning and welcome to Wisdom to Wealth. Thank you for joining in. I'm Whitney Hammond from Sovereign Wealth Management. Jim Ruta, AdvisorCraft, is joining me here today to discuss the 3 ways to use life insurance. Whether you are just getting started in your investment life, looking to manage your money yourself, or working closely with a financial advisor, Wisdom to Wealth discussions will provide a roadmap to the life you want and deserve. Okay, so welcome, Jim. How are you today?
Thanks, Whitney. Always great. I can't complain.
Okay, so life insurance is often a misunderstood product and it's not seen as a lifestyle. So let's just have a chat about that today. Obviously, you and I are huge fans of life insurance, and there's a reason why that we are. We've spent decades and decades. I'm 25. Well, I'm 25 years in the business, but I also come from a life insurance family. So really, it's been 56 years for me, and it's probably been close to that for you. So yeah.
Only 40. Only 43 on Monday. So Monday will be 43 years for me.
That's pretty awesome. That's great. It's a great way to spend our life, and definitely advocates helping many people. So let's just have a chat about that. So the 3 ways to use life insurance.
So Whitney, you're right. This is a misunderstood product a lot of times. Of course, it's got a stigma attached to it, got lots of stuff. But, over the years that I've been working with clients and financial advisors, I was licensed for 25 years or longer, actually. I really come to understand it in a different way, and especially during the pandemic, because we've done an awful lot of study and research about it. You see, life insurance is really key to what I call essential financial security, to give you the peace of mind that is quality of life. And there's a great line from a friend of mine in Denver, Colorado: peace of mind equals quality of life. I think we need to remember that. But not all life insurance is the same, and the reasons for buying it are not all the same either. So let me give you a little bit of the Jim Ruta course on this. There's the first reason people buy this, sort of technically speaking, is short-term tax-free cash at death. Short-term tax-free cash at death. Now, all life insurance is about tax-free cash at death. Tax-free money comes to you when you need it most. And only life insurance can deliver the right amount of cash at exactly the right time when you need it most and have it least. Now, the simplest life insurance is purchased on the life of the person to provide tax-free cash at their death to provide for the well-being of those people that they love. So term insurance of various terms, and there's, God knows, there's all sorts of this now: 10, 15, 20, 25, 30, 35, 40, 45. No, sorry, that's something else. To age 65 and others, provides tax-free cash to cover financial responsibilities that terminate, sort of hence the name, terminating insurance. These are responsibilities like a mortgage, supporting young children until they leave high school or college, or to cover other loans and obligations and other needs that have a given expiry date. So responsibilities that expire really work well with terminating term life insurance in that response. So like I said, term insurance covers responsibilities that terminate. Remember, it's actually designed to terminate before you, and that's before you do. And that's really why it's less expensive than other kinds. The second way that people use this, I'm talking about prudent investors. And you talked about investors at the beginning. I think that's really true. It's prudent people do this stuff. Who buys wax and wax of life insurance of all descriptions? Silly, poor people? No. The wealthy, smartest people with access to the best information and tax advice that they could possibly get is who does this. But the second way, the first way was short-term tax-free cash at death. The second way is long-term tax-free cash at death. So this is also life insurance on the life of a person, but it's financial. It's for financial obligations that don't really come to life until you stop living. Whenever that might be, right up to age 100. Now, policies here can be term to 100, universal life, term to 100, non-par whole life, par whole life, all descriptions like that. Now, we buy a permanent policy for a permanent need, for needs that don't expire until you do, so to speak. And permanent needs include things like medical, burial, and funeral expenses, terminal income taxes, any outstanding financial obligations, special bequests, special needs children needs. That's a big deal. Business needs, of course, and something you talk about all the time, and philanthropy. The idea is for this permanent insurance is to get the best value for money for the long term, or a cost-effective way to cover a financial responsibility or liability upon your death to protect someone or something that you love. And for example, if it's true, and I believe that it is, that life insurance is the least expensive way to pay for final expenses. Clearly, insurance would be the cheapest way to pay for, that final expense thing, whatever that might be. And it includes a bunch of things, obviously. But if that amount is even $50,000, all costs and tax included, burial, medical, all that sort of thing going on, then the question is, when will it be needed? One of the questions we often train advisors to ask clients is, when did your parents or your grandparents die? And if they're still alive or they're very old, well, do you imagine that you will survive that long too? So a 40-year-old that may have 85-year-old grandparents and hope to live at least that long is kind of that person we're talking to. So if so, at a 3% inflation rate, which is likely in the new world coming up, I think, and using the rule of 144, this is a different version than the rule of 72, but the rule of 144, you divide 144 by the inflation rate for the number of years to triple. Well, you divide 144 by 3%, we get 48 years to make final expense amount about $150,000. And that's just for final expenses. So almost anybody could buy 150 for permanent expenses, certainly in their 40s, to do it that way. See, here's the thing. No one knows when they will die. And whatever you plan for, you will likely be wrong. You could buy too much or you could buy too little. The question is, do you want to be wrong so your family is advantaged, or wrong so that your family is disadvantaged? You see, you can choose. So this discussion between short-term tax-free cash at death, long-term tax-free cash at death, this is really the general discussion we have. And what you need in terms of term insurance or anything else has to do with the size of your obligation, the length of time you want the protection, the amount of money you have available to work with. Now, again, this is what financial advisors, life insurance agents deal with their prospects and their clients all the time.
Yeah.
Sorry, you probably have something to say, but just yakking here, but sorry.
I just have a quick question. There is a comment that, or a common belief, people will think that, hey, you know what, by the time I get up there, and it doesn't really matter how old you are, but by the time I get to that time in my life, I'm going to have so many assets that my assets will just clear out this. And so I have an answer to that, obviously, because I can see these things. But what do you feel about that?
Yeah, it's interesting. There's a lot of people who say, by the time I'm retired, I have so much money, I won't need no life insurance. You kind of get that kind of thing going on. And here's the weird thing about that, is that, our needs kind of grow. Life has really changed. You see, the use of the product changes over time. Originally or initially, often we're creating estates, that short-term tax-free cash at death. We're creating money for an estate early on. And then later on, what we find is that we use it for either for preservation of estate. Of estates, and there's no end of things. So, and the other thing that really gets me about this is that, and that, let's just say that's right. And, but the government will get their money. So whatever taxes or whatever fees, whatever costs, or whatever you have, yeah, that'll all work out. But here's the point. Would you rather spend 100-cent dollars or 3 or 4 or 5-cent dollars to pay for those final expenses? You see, if the nobility in your family has to start with you, which it does in my case, because I came from a very poor background, or a very lower middle class kind of background. And for the great things to happen, it'll have to happen with me and my end of the family, at least. Yeah. You see, so I could either spend that expensive money, or I could use inexpensive money. My buddy Tom Hegna, who I wrote this book with, Don't Worry, Retire Happy, that one. He says, here's another idea. Why don't you spend all your money in your retirement and then leave insurance to your kids? So there's probably 4 reasons why it's a bad idea to just pretend you won't need the insurance later on. Does that make sense?
Well, Yeah. So the one thing that I've noticed over the decades is that as we're, and including myself, as we're building our wealth, we have different assets. And one of them is real estate. And let's face it, there's people that have 4, 5, 6, 7, 8 properties. They may have one and just two. And so, for example, that's a really like when you're doing your estate planning, why would you want to liquidate stuff to give to your children versus saying, hey, I got this cool stuff that I've owned for like 40 years. You can't buy it anywhere near the price. The stuff that I have now, are you kidding me? If I drop dead tomorrow, my kids had to rebuy it. I can't even afford the house that I live in now with the prices.
Yeah.
So the thing is that in order to have assets stay, we don't want to be liquidating them. And also too, what I love about the permanent cash value life insurance is that I don't see a cost to it, because when we're depositing cash into our contract, that money is still sitting on our balance sheet. It didn't go away. It's still there. I can get it if I need it. So again, like the more assets that we have, this tool really, really fits in because it's not a cost, and it's actually a lifestyle where you realize that, when I'm not here anymore, things will carry on. Death is untimely. It never happens where everything is signed and it's all going to flow this way. Usually what happens is like, holy crap, where are we going to get money to fix this, fix that? Look at there's postmortem planning. For postmortem planning, for anybody who doesn't know what that is, that's all the pipeline planning that gets done after you pass away. And there's this significant wealth that can be saved in this type of planning. And of course, it's just people don't understand this, and it doesn't generally get talked about with the accountant. It may get thrown on his lap or her lap later, and it may get looked at and it may not get looked at. So these are the kind of things that we really, really want to look at, because as you're building wealth, I mean, let's face it, that's what we're doing. If we're not building wealth, we're not watching this video.
Yeah.
We're building wealth. We're looking at how can I do this smartly? So first of all, protect my family. Second of all, I want to build more wealth. And third of all, I don't want my stuff liquidated when I'm not here. Who wants to sell off a commercial property? I mean, really, it's a lifetime of annuity income. These rental incomes that are coming in. I mean, so I love what you're saying.
Yeah, it just builds the legacy, and that's what you want to do, and I think that's what the wealthy have done for many years. You see, they continue to do this so that the family continues to improve over the generations. And if that's what you have in mind, then life insurance is a big role. One of the things that people often ask, I mean, and I think this is the point about whether you'll need it in the long term. I think we can discard that, I think, for the most part, for most prudent investors. But there's also the question about how much do you actually need? And, when I look at this thing, I think about a friend of mine who does extraordinarily well in Pasadena, California. And he talks about how, everybody, to provide survivors income, you need about 20 times your gross income in life insurance to cover that off. So if you're making 100,000, you'll need $2 million. Because at 5%, supposing you could get 5% in a secure kind of guaranteed investment, your survivors will still get that $100,000 that you were making. Well, is that too much, Jim? I don't know. Pre-pandemic, everybody pretty much spent everything they made and then some. They put that on the credit cards, right?
Yeah.
That was kind of the deal. But here's the thing: it's not magic. You can pick to say, look, 20 times gives you 100% at 5%, 15 times gives you 75% at 5%, and 10 times gives you 50% at 5%. So simple math. Add to that the size of the mortgage, some obligations you want to pay off, putting the kids in college, that kind of thing. And you know what? That's the kind of number. You don't need extensive planning to figure this part of the financial plan out. The stuff that you do, that high-tech stuff that goes way deeper, that's something different. But this stuff can be very simple. See, yeah. And then we get to the part that you were talking about. We kind of talked about the last time I was with you, is this what I call long-term tax-free cash for life. So remember, short-term tax-free cash at death, long-term tax-free cash at death, and now short-term as rather long-term tax-free cash for life. I call this the cash for life plan. You talk about this, that bomb shelter money. And then again, it's bought, you buy it for yourself. I mean, even though it's on you, but you buy it for yourself to provide tax-free cash for life and for the life of you, the life insured, not just for the welfare of beneficiaries. Of course, it still does both jobs, because this allows you to be the beneficiary of your own life insurance policy while you're still alive. You have done that. I have done that. Many, many people have done that. And it's an extraordinary opportunity. And you can do this because life insurance for someone takes advantage of the extraordinary actuarial construction of the plan, generous government income tax exemptions for its societal and economic value, and the miracle of compounding over time to create an asset that only grows in value, can never lose value, grows tax-free, values can be accessed tax-free, and finally will be paid out to your beneficiaries tax-free. It's an extraordinary piece of financial property. It's a piece of financial property. And for that, you and I have the same deal. Cash value life insurance, the old plain vanilla, paid up stuff, paid up additions. Man, we love doing that. And that's really what this is all about. But I want to say something first that's important. So there's three kinds. But remember, the most important thing you can do is to get the right amount of coverage for yourself and your family. That I don't care if it's term, any one of those needs, I don't care. Just make sure that if something were to happen to you, someone that my old buddy Roger Zener used to say many years ago, if one day you become part of the grill work on a Mack truck coming home from work, that the family will be taken care of in the way in which you want. And so those are the three ways that I see prudent investors doing this. It's straightforward stuff. And all you need is a great advisor, just like Whitney Hammond, to help you sort of pick your way down that road and see which and of those three ways you should be using and which combination of them would be best for you.
Yeah. So just to summarize what I hear you saying, Jim, is so for something, short-term needs, term insurance, it's very, very inexpensive. Get 2 million, get 5 million, get whatever, the math works. That's very, very affordable. But then we start getting into the long-term needs. And then we start getting into let's pay ourselves. And that's one of the things that I really love. And I just want to say quickly is that you can put money into these contracts, okay? And you can take money out of the contracts and you still have a big death benefit at the end of the life. So we've been doing a lot of work with particularly business owners, because there's a lot of cash and retained earnings and they need somewhere to invest it. So it's just it's build your own pension, become your own bank, and be in control of your own finance and be able to have that money and access that money, have it on your balance sheet, and just live a really, really comfortable life. And you did mention disabled children. I just wanted to touch on that briefly. So we do have, we have the state equalization with families with children, and then we have families that have special needs. So there's families that you may want to have like a spendthrift, and there's families that there may be a special needs child. And so what that would be is somebody who is a ODSP qualifier. And so a Henson trust can be set up for this child. And a lot of times what we do is we have life insurance that flows through what we call, it's just a mechanism, an insurance trust. So it actually bypasses probate and it puts this money into this Henson trust for this child so they don't lose their disability benefits, which is their ODSP benefits. And there's an amount of money there that can be used to take care of the adult child. And what's really nice about it is that a beneficiary can be named on this Henson trust. And so the parent can say, gee whiz, you know what? I want my child protected for, and we see this a lot with Down syndrome. I have a lot of clients with Down syndrome children, and it's amazing. I tell you that it's such a beautiful relationship. It really is. The parents live a super long time because they never want to leave that child. I love these relationships. I'm beyond having babies now, but if I ever had a Down syndrome child, I love them because I love my clients' adult children. They're like, they stay children all of their lives, and you can't help but to love them. But the parents want these children to be taken care of. And a lot of times what we do is we do some life insurance where we're able to fund that Henson trust. And we're also able to name a beneficiary of the the Henson Trust, should the child pass away, the proceeds of that trust will go to the other children in the family. So there's so much creative planning that can be done with insurance. And we never place a policy unless we know the math works. The math has to work. It has to show a good rate of return to the family. Otherwise, we never place it. And so we do math for a living, and it's really easy to run an internal rate of return, and it's really easy to run a return on the estate, the return to the estate. So we know, we'll look at it, we'll say, hey, you know what, this doesn't work. Or we'll look at it and say, holy smokes, you know what, you would need to earn, and a lot of times you'd need to earn like a 20% return, pay your tax to net down to your 10% return on your insurance. So I know that that talk is a little bit tough to understand, but we know how to figure that out. And insurance has been around for 400 years. So it's not new. They've been doing actuarial underwriting for 400 years. And it's a great science. So yeah, so Jim, thank you for joining me today. I think we should close off. And did you want to take the last word?
I was going to say,
and your book. I want to address that book too, because we want to start.
Let me just say one thing before we get to the book, just quickly. The one thing about the Cash for Life plan, the long-term tax-free Cash for Life program, but that idea, and it's not a plan, it's just an idea, and certainly Whitney can help you with that. The idea behind that really is simply this: is that every dollar you put in there, you get back and then some. It's the one thing, it's the one policy, the one plan that you're guaranteed to take advantage of somehow. And you said something before, it's really important. There is life insurance planning to do. If you just see this as a commodity, you're gonna miss out on some huge opportunities. So I was talking about this book here. Of course, I throw in a couple $1 million with it as well, you know, kind of do it this way. But I was talking about Don't Worry, Retire Happy. Talks in here about one thing on page 161, talks about what does life insurance have to do with retirement. It's a great book. If you're interested, I'm sure we can find a way to get it to you. Talk to Whitney and she'll help you. And certainly you can find my stuff on my website at jimruta.com.
Awesome. That's awesome. And I think we're going to start doing some book giveaways. So we'll talk about that at the next. So you and I will be back on live in 2 weeks. So every other week, Wednesday at 10 o'clock, please join us. And any questions, keep sending them in. We're busy and we love to answer them. So have a great day. And thank you, Jim.
You bet. All the best.
Okay. Bye-bye.